An $87 million business sale with no investment or tax strategy. This was a call I got, and that was the bad news, because that's a big tax bill with no strategy. The good news was that 2 million of the 85 million was a holdback. And a holdback is a payment that's received from a buyer of a business, typically 12 months later. And that does provide some interesting tax planning opportunities. So today, I'm going to walk through step by step how you can eliminate the taxes on that $2 million holdback, which saves $400,000 in federal taxes. So here's the situation. It was around the end of December, and there was a large transaction that closed in which I got referred to. This person's brother-in-law was actually a financial advisor, but didn't necessarily have the fluency in all of the tax and investment strategies of someone that deals exclusively with business owners who are going through a transaction. So when we got on the phone, the client, frankly, was frustrated because he didn't think that he had gotten sound advice, but that's common without operating in a niche. And so when we got on the phone, we realized that you did have this $2 million holdback that presented interesting tax planning opportunities. Unfortunately, if we would have known this person a few years in advance, or even 12 months prior before the deal, so we could talk about structure and timing, instead of paying 17 million, he could have paid potentially 13 or 14 million for federal taxes. So let's get back to this holdback. So after paying $17 million on this $85 million cash payment, the client was left with a $68 million portfolio, a substantial amount of money to invest, but not only to use a portion of that to earn an investment return and to make sure that they pay zero tax on that $2 million holdback. So I'm going to go step by step through tax loss harvesting, which is a strategy that we used to eliminate that tax. A lot of people have heard about tax loss harvesting, but are too scared to ask what it actually means and what are the mechanics. So let's break that down, and I'll start with what I consider to be level 1 tax loss harvesting. So let's say you have a person who wants to own the S&P 500 index. The S&P 500 index has been one of the best investments over the past 100 years and is easily accessible to all types of investors. So let's say they wanted to buy the S&P 500 index, and we're going to do that through an exchange traded fund, which is typically a very low cost way to do it. And this exchange traded fund will represent, it's one security that represents 500 components of the S&P 500. So let's say you go out and you buy this S&P 500 ETF for $100 per share, hypothetically. If that S&P 500 index goes down from $100 to $90 per share, you can actually sell that index ETF at $90 per share and lock in that $10 loss. That's called tax loss harvesting, okay? That $10 loss never expires, and it can be used at any point in the future to offset a capital gain in someone's life. That could be real estate, it could be a business sale, it could be a gain on a private equity fund that you own, it could be a gain on a stock that you made money on, okay? And that strategy by itself is fine, and it can have a small impact, but it's not going to wipe out a $2 million business sale holdback. So that's version 1. Version 2 is something that's commonly referred to as direct indexing. And there's around $600 billion managed under the strategy that I'm about to describe. The reason it's called direct indexing is because instead of owning a single ETF that represents 500 components of the S&P 500, direct indexing means that you actually use quantitative strategies that own those 500 stocks directly. And if you own 500 securities instead of one, it allows the quantitative model to take advantage of all of the dispersion and volatility associated with 500 stocks. So you can imagine, let's say Coca-Cola goes down 20%. You lock in that loss and go out and the computer buys Pepsi or some other similar security until this 30-day wash sale window has closed and they can buy back Coca-Cola. So effectively what's happening is that you're continuing to track the performance of the S&P 500 index, but you're generating these tax assets along the way. And what do I mean by tax assets? So these are losses that are being harvested while you're still gaining this investment exposure and the returns of the S&P 500. And this is a great strategy. It's been around for years and years, but has recently become available to a more broad swath of investors. And typically there might be a $250,000 minimum or even lower, substantially lower, associated with this strategy. So this strategy here, given the right investment amount, by itself, that could actually wipe out this holdback on the business sale. But that's only because this client has a $68 million portfolio. So I estimate that, with just 13% of that $68 million portfolio, you could wipe out the holdback that they're going to receive over the next year. But that might not be the most efficient use of capital, although I see that as a very valid strategy because 13% of a $68 million portfolio is not a substantial equity holding in that many investors might have 60% or 80% invested in the S&P 500. I'm not saying that's a recommendation that I made for this client, but that's just an example of what you see in more conventional portfolios. And at Essential Partners, we not only use this level 2 direct indexing tax loss harvesting strategy, but we will also use more advanced tax loss harvesting strategies depending on the profile of our client. In this situation, we were able to deploy some of those advanced strategies that provide far more tax loss harvesting benefits than direct indexing. And these strategies can not only wipe out the taxes on a holdback, but let's say in this exact scenario, we were to have this client that had this gain at the beginning of the year, we could have reduced this capital gain and reduced the tax that they were paying by $3 million or more. So while we're happy that this led to a solid outcome of eliminating the tax on this holdback, so saving the client $400,000 in this scenario, if we would have known them and been introduced to them at the beginning of the year and deployed a similar strategy, we could have saved them $3 million or potentially more. So these are the types of strategies that we're deploying in order to save business owners money on taxes, particularly in a transaction or a holdback in this scenario. So in future episodes, we're going to dig deeper into these advanced tax loss harvesting strategies, and we're also going to discuss how they can be deployed to reduce or eliminate taxes on rolled equity. And rolled equity is when a private equity acquires your business, and in return, you take a portion of that acquisition value and reinvest it in the private equity roll-up business that acquired you. And what that leads to is somewhere down the road, whether it be 2 years or 7 years, you're going to have another large capital gain, and that gain and the taxes associated with it can be drastically reduced by deploying some of our strategies. And lastly, in future episodes, we'll talk about how to reduce your ordinary taxes on investment income by using a combination of some of the investment first, but yet tax efficient strategies that we deploy at Essential Partners. So stay tuned.